crash is here. For many people, it's going to be the worst thing that's ever happened to them. I don't care if you're in stocks, bonds, mutual funds, real estate, gold, or silver, or Bitcoin. This crash will bring everything down. Now, the good news is that's when you get rich.
Yes, you heard that right. Even when the economy isn't doing well, knowing how to manage your money can help you succeed. And Robert Kiyosaki is here to help you learn how. Today's video is a deep dive into the pressing concerns raised by Robert Kiyosaki about how to turn the looming recession into an opportunity to make money. Within this crisis lies a golden opportunity. The key to understanding this crisis actually lies in the very nature of money itself. In this video, we'll not only explore the uncertainty surrounding traditional currencies, but also reveal unexpected strategies for capitalizing on economic downturns. Get ready to challenge your perceptions and dive headfirst into the complexities of global finance, with a bonus insight that will leave you ahead of the game. In this video, we're not just scratching the surface. We're going deep into the heart of the matter, offering you a nuanced perspective that sets us apart from the rest. This isn't just another video. It's your guide to navigating today's financial landscape. Stick around, because you won't want to miss what's coming next. Robert Kiyosaki recently highlighted the looming crisis in the global financial landscape. He described the situation as a big mess, comparable to a precarious structure on the verge of collapse. Kiyosaki emphasized that this crisis is not a distant concern, but an immediate reality unfolding before our eyes. Central to the issue is the uncertain nature of money itself. Traditional forms of currency, like the US dollar, are facing challenges from emerging alternatives such as Bitcoin and the potential introduction of central bank digital currencies. This uncertainty has sparked speculation and panic as people grapple with understanding the implications of these changes. The dominance of the US dollar as the world's reserve currency since 1944 has granted America significant economic power. However, it has also led to various problems. Kiyosaki warned that losing this reserve currency status could have profound consequences, as evidenced by recent disturbances in financial indicators like the yield curves. A key aspect of the current financial system highlighted by Kiyosaki is the role of banks in creating money. He pointed out that the vast majority of dollars in circulation are not physical currency, but rather exist as digital representations created through lending. This means that when individuals deposit money into banks, they are essentially entrusting those funds to the bank's discretion, as the bank can use those deposits to extend credit and generate more money. He also touched upon the concept of central bank digital currencies and their potential impact on individual freedoms and privacy. Kiyosaki expressed concerns that moving individual accounts from commercial banks to the Federal Reserve could have Orwellian implications, as it would consolidate control over people's finances in the hands of central authorities. He emphasized that banks, particularly those outside the United States, wield significant influence over the global financial system. He highlighted the prevalence of euro dollars and similar instruments, which are essentially dollars held outside the jurisdiction of the Federal Reserve. He emphasized that the majority of dollars are created through lending, rather than being issued by the government. This means that the money supply is largely determined by the decisions of banks and financial institutions, rather than by government policy. When you deposit your money in a bank, it technically becomes the bank's liability. This may sound counterintuitive, but it's because banks are responsible for using customers' deposits to generate returns, such as paying interest on savings. However, Kiyosaki points out a problem with this system. Banks often invest customers' money in various assets, including debts. If these investments go sour and the bank's assets lose value, it can lead to a situation where people start demanding their money back all at once. This scenario, known as a bank run, can spell serious trouble for the financial system. Moreover, Kiyosaki raises concerns about the increasing surveillance capabilities of central banks, particularly in the context of the rise of central bank digital currencies like Fedcoin. He likens this level of surveillance to the dystopian world described in George Orwell's novel 1984, where a powerful entity known as Big Brother monitors every aspect of citizens' lives. With CBDCs and blockchain technology, there's a real risk of losing financial privacy, as every transaction can be tracked and monitored by authorities. Kiyosaki emphasizes the importance of privacy and the dangers of sacrificing it in exchange for perceived safety and security. He acknowledges that during crisis, people may be willing to relinquish their freedom, but warns against the long-term consequences of such actions. Furthermore, he touches upon the issue of bank safety and the role of institutions like the Federal Deposit Insurance Corporation in protecting individual savings. While the FDIC is meant to safeguard deposits up to a certain amount, Kiyosaki points out instances where it had to intervene on a much larger scale to bail out failing banks. This, he argues, creates a moral hazard and undermines the principles of capitalism. He points out that trust in the system has eroded, and this presents an opportunity for central planners and authoritarians to seize control. Kiyosaki draws attention to the banking crisis, echoing concerns raised by historical figures like Thomas Jefferson, who warned against the perils of a central bank. The consequences of such a system, Jefferson predicted, could lead to widespread homelessness, a problem that is unfortunately rampant today. The heart of the matter lies in the functioning of institutions like the Federal Deposit Insurance Corporation, tasked with insuring deposits in banks. However, as Kiyosaki notes, the FDIC's resources pale in comparison to the magnitude of deposits in the country. With only a fraction of the necessary funds, questions arise about the security of individual savings in the event of a financial collapse. One potential solution proposed is to move funds from commercial banks to the Federal Reserve, seen by some as the safest institution. However, Kiyosaki cautions against this perceived security, likening it to a deal with the devil. He underscores the importance of maintaining freedom in financial decisions, highlighting the risks of blindly trusting centralized authorities. Drawing from his experience, Kiyosaki evokes a blunt analogy from military school to illustrate the unpredictability of the current economic landscape. He asserts that the value of cash is dwindling, emphasizing the need for vigilance and informed decision-making in uncertain times. Kiyosaki echoes his famous quote, "Savers are losers. The rich don't work for money." He underscores the importance of staying away from traditional investments like paper assets. Drawing from his experience of taking a company public, he stresses the significance of owning shares directly rather than relying on others' investments, citing the risk associated with counterparties controlling one's assets. Using a vivid analogy of a tsunami, Kiyosaki illustrates the unseen but imminent threat facing the economy. He describes how advanced detection systems can sense the approaching danger, akin to the warning signals provided by economic indicators like the Y-curve. Despite not knowing the exact timing or impact, the signs of a crisis are unmistakable. Highlighting the cracks in the economic foundation, Kiyosaki expresses concern about the fragility of the monetary system, which relies on creating money out of thin air. He warns of the repercussions of America's debt-fueled spending and the decline of its global dominance, signaling potential instability in the dollar. Kiyosaki criticizes traditional investment vehicles like real estate investment trusts, labeling them as foolish and fake. He explains how saving money in banks, once considered a safe practice, exposes individuals to risk, as banks use deposits to finance their own investments, leading to a situation where they struggle to cover liabilities. Kiyosaki underscores the inadequacy of these measures in addressing the underlying issues, suggesting that attempts to patch the cracks in the system only delay the inevitable. Despite the looming crisis, Kiyosaki laments the lack of awareness among the general public. He points out the inverted yield curve, a phenomenon where short-term treasury yields surpass long-term yields, as a clear indicator of economic distress. Yet, it remains overlooked by many. He explains that the yield curve reflects the relationship between short-term and long-term interest rates. Normally, long-term loans carry higher interest rates due to increased risk over time. So, when short-term rates exceed long-term rates, it's like a red flag waving, indicating potential economic trouble ahead. He elaborates that historically, such occurrences have foreshadowed recessions or even depressions. Kiyosaki points out that although cracks have already appeared in the financial system, the full-blown impact hasn't hit yet. Comparing it to a tsunami, he suggests that while the ship might not be disturbed by the swells at sea, it's when the wave hits land that the devastation occurs. In this analogy, the financial system represents the ship, seemingly unaffected for now, but vulnerable to the impending crisis. He emphasizes the importance of monitoring the yield curve, especially the moment when short-term yields dip below long-term yields. Historically, this event has often preceded economic downturns. Kiyosaki suggests that the current situation indicates a possible recession post-summer or fall, urging individuals to pay attention to these warning signs. So, what can people do to get ready for this big problem? Robert Kiyosaki shares what he's doing with his money. He's not keeping all his money in cash, but he's keeping a lot more cash than usual. He's almost got 10% of his money in gold, real gold that he can hold, and he's putting some of his money in short-term treasuries. These are like IOUs from the government. He likes them because they're not tied to banks. He's worried about banks not being able to pay back what they owe. It's like if you lend money to someone who's always asking for money but never pays back. You're taking a risk. He doesn't want to take that risk with his money. He'd rather keep it close. He compares this situation to a warning sign, like when the water goes out at high-low before a big wave hits. You don't wait around for the wave to come and catch fish. No, you start moving away from the danger as fast as you can. If you pay attention to the warning signs, you can protect yourself and your family. And that's what Robert Kiyosaki is doing, and he thinks others should do the same.